Thank you, Tracy. Excited to be here today to talk about financing of retail real estate. We're going to cover lending and underwriting trends going on in today's environment. We'll talk about appraisals and valuation issues that have arisen and other lending topics. And we're going to kind of take a conversational tone to the discussion. Our panel members, one who appears to be on a gray screen right now, is Pete Megenberg. Pete Megenberg was the founder of Megenberg Research, a commercial appraisal firm. He has 30 years of experience. He does appraisals for really all commercial real estate types, from multifamily, office, industrial, and of course retail. A lot of breadth across the state of Wisconsin and the upper Midwest, but also has some national clients that he works with. I also have Tom Moss with me. Moss has about 18 years of banking experience, the last 11, I believe, with Landmark Credit Union. He has lent on all property types and also banks operating companies, so he brings that additional perspective to lending. Let's see here. Tom is also a team lead at Landmark. He leads a team of lenders and portfolio managers and has financed quite a bit of retail from standalones all the way up to $20+ million multi mixed-use developments. So I think it's a great panel. I've got 8 years at Landmark and 16 years at a super regional bank before that. Hopefully we can give you some perspective on what's going on in today's market from the lending side and the valuation side. With that, I'm going to ask Pete to start us off. Pete, are you there?
I think they're working on getting Pete back on.
Okay. All right. Tom, then I will go to you. How do you think underwriting is and will be affected by COVID?
Oh, there's Pete.
Oh, there we got Pete. All right, let's start with Pete. Welcome aboard.
Wow, sorry about that, guys.
All right. That's all right. We'll start off easy. So COVID gets announced. You know, it's everywhere, and you've got to do your first physical inspection of the property. Were you scared at all?
Well, it's kind of like meeting the future in-laws for the first time. You got to keep your distance. Be careful. And, you just have to keep your distance. Now, we certainly there's a protocol that whether it's visiting the inside of a piece of real estate or shopping at a marketplace, you know, there was just protocol that you had to follow. Many of the clients allowed us a very long leash insofar as if we chose to just do an exterior inspection, that was fine. Alternatively, we were able to rely on photos that had been taken previously by property representatives. So I think flexibility was the order of the day, and we simply were able to adhere to the client's requests. Sometimes they didn't want us in the building, but again, you know, other times, you know, there was a standard protocol that everybody respected. And if as an example with multifamily, if you typically would see out of a 100-unit property, maybe 5 units, maybe you saw the clubhouse and a representative few units, but not all 5 units that you typically would see.
Has there been any change in timing that people should expect when they're writing contracts or trying to get a refinance done? Pete?
What was that for me?
Yes. Yeah. Any
Okay.
change in timing on those appraisals?
Yeah. I think that what we're seeing is, and what we have seen thus far for the past 6 months, is a less efficient process in the delivery of material that we would rely on for an appraisal, whether it's surveys, rent rolls, past financials. With everybody working from home, there is that element of lack of coordination when trying to interface with multiple sources as opposed to a one-point source at an office. So yeah, we found that maybe the standard 3-week turnaround is elongated to 4 or 5 weeks as a result of the inefficiency.
Okay. All right. That sounds good.
So I think
Well,
that's my cue. You know, back to you, Adam. How are lenders feeling about you know, the lending environment today?
you know, the reality is there's still lots of good deals out there, and we've been seeing a number of them this year. The deals that are most attractive right now have those financially strong tenants. I mean, at the end of the day, you're looking at you're looking at tenant financials. You're looking for medical tenants, financial tenants, discount retail tenants. I think on the restaurant side, if you've got corporate or large franchisee tenants that you can actually get financials on, that can be an attractive deal. Grocery anchored centers are back in the mix, I would say, of good quality product. But we do want to make sure that, for example, if you're looking at a pick and save deal, does it have that Kroger guarantee? Some assurance that the tenant is going to stay through an option period or a possible lease maturity. Lenders are still assessing e-commerce risk, so it's not like that risk went away. So when we're looking at deals, we're definitely trying to get our arms around what the tenant is doing for their business. Is it something that is potentially safe from the e-commerce risk? We are also looking from a COVID perspective, I would say, what is the likelihood that this type of tenant might want to shrink the size of their space at a tenant rollover time, at a lease rollover time. And then I think there's hopefully it's a temporary concern about your high contact spaces. So those would be your fitness centers, your dance studios, those kind of tenants that, whether they're strong or not, there just may not be interest in the public attending those types of tenants. And any situation where you're too reliant on local or limited credit tenants is going to be much less attractive. Tom, taking that a step further, how are you feeling about underwriting of retail in today's environment, especially as it relates to COVID?
Yeah, I mean, I think obviously a lot of challenges for a number of tenants. It's difficult to specifically identify which tenants we might see vacancy in, but I think us and a lot of lenders are just assuming there's going to be some increased vacancy in 2021 and beyond. So we're being when we're looking at stress testing pro formas to make sure that loans are appropriately leveraged to handle an increased vacancy that might come up down the road. We're taking, as you mentioned, we're taking a harder look at when leases roll and if lease options are going to get picked up or not. And some of those questions are unanswerable, but in this year and maybe going forward, it's a little less likely that those are going to get picked up, or if a lease does come up, maybe a larger or mid-box tenant's going to want to take less space. So you might be presented with a challenge where you could keep a tenant, but you might have to demise the space and squeeze them into half or 3/4 of the space they're taking now. So those are all concerns. We just want to make sure that we've got the appropriate loan amount or leverage amount on a deal that can handle some increased vacancy going forward. So I think in general, we're seeing lower rates, but if you've got a deal that you don't have a long-term credit lease on, you're probably seeing tightening advance rates and a little shorter amortizations as deals are getting. So I think developers, borrowers out there, investors, need to figure a little more vacancy into their pro formas. We're certainly see some offering memorandums with some blue sky numbers. I know Pete's used to seeing that too. You know, but we're going to take a look at that a little bit closer and see. And then, you know, another big point is who the sponsors are and what kind of management team they put in place. You know, we've always had those conversations in the past, but it's becoming more important as we get further into this pandemic. Is you know, what's the experience of the investor, of the loan guarantor? What kind of team have they put together? That if you have a vacancy or need to backfill some space, who are you working with, and how are you going to manage those challenges ahead? So a lot of that has been points that we focus on in the past, but there's just a renewed emphasis on it as we go forward. Pete, I guess, how are you kind of incorporating, you know, the challenges that we're seeing in the retail landscape currently in your reports when you're looking at properties these days?
Well, you know, somebody much smarter than our collective whole once said, don't learn from history, tend to repeat it. And, you know, we all went through the cycle of 08 and thereafter. And what we found with that, and then the imposition of Dodd-Frank, was the level of scrutiny that all underwriting to all asset classes must had to adhere to in order for a deal to go forward. And what we're finding today is that there are very few, as a deal matriculates through the process of its underwriting, very few unanswered questions. And it seems that even the simplest deal to a commercial bank, it must subscribe to the same level of detailed underwriting that deals back in the mid-2000s had to subscribe to with a CMBS note. You know, CMBS notes were notorious for having very thorough, very comprehensive analyses performed, and the level of paperwork associated with most CMBS notes was extensive. But again, today, with the diligence imposed by bank regulators and others overseeing the administration of a bank, credit union, or other capital or equity source, that level of scrutiny seems to apply to virtually every deal. With regard to retail, we're seeing there's a continued separation of underwriting. There's not one deal that could be that mirrors another deal in terms of its underwriting. We, again, going back in time, when CMBS lenders looked at deals that had any specter of risk associated with them, there was a great deal of indifference to any vacant space. So deals that may have been brought to a CMBS lender that had any vacancy would simply get no credit for underwriting. And we're seeing some of that today. You know, the notion when the internet really started to take force and e-commerce became a significant element, there was the notion that there were certain internet resistant retailers out there. I don't know of any internet resistant retailer that exists today. And so the landscape has changed. What we're seeing is a separation by credit quality, but we're also seeing a separation by physical plant. Obviously, there's a lot of bricks and mortar in the retail space that's antiquated, where the sponsors haven't kept up. There's significant deferred maintenance, and consequently, the product in that category will quickly reach the end of its economic life. So repurposing is going to be a big part of our landscape for the coming half dozen years or more.
When we were talking earlier, I was trying to get an understanding of how an appraiser takes potential risk into an account in an appraisal. I believe you said it's really not part of the scope of the appraisal, but does that matter? Does it depend on who the lender is?
By definition, potential risk can take many different forms. Let's say, as an example, there is a fairly decent regional credit as one tenant within a multi-tenant building, and that tenant is paying an above market rent. Clearly, the standard practice in the appraisal world is to take the above market rent and discount that back to a present date and time at a discount rate that's reasonable and reflective of opportunity cost, and capitalize what would be a market rent for that space. So for instance, if a decent credit still has 4 years left of term, and the prevailing market rent is $10 and they happen to be paying $15 per foot, you would take the $5 above market rent, apply that to the space leased, discount that over the 4 years to a present point, and add that to the capitalized value, which would be predicated on a $10 net rent. That would be standard procedure. In years past, when we had high growth and there was expectation that a property had particular attributes that distinguished it in the marketplace, you may find certain appraisers capitalizing that $15 rent, using my earlier example. But that's not the case today. We know that the reaction by the lending community would not allow that, and consequently, that's just part of our DNA as an appraiser to view property with a somewhat more cautious outlook.
That's interesting. So if we're not seeing any decrease in rental rates yet, there isn't most likely going to be any discount done like that. There's not going to be a capitalization of above market rent.
Well, I would not say that there's currently and likely in the near future, meaning in the next couple of years, a decrease in rent. I think you're going to start to see softness at the fringes when the anchor leaves. I think many of the tenants that rely on the foot traffic from an anchor will begin to invoke clauses within their lease agreement that permit them to terminate early. And that creates a mounting problem for the sponsor or owner of that real estate. So I think that the decline in rent can be, prima facie just to the lease itself, just on the surface, whatever the rent is. If it's 15 today, maybe it's 12 tomorrow under new underwriting. But the net operating income could be affected by other factors, such as the orientation of a property to its marketplace. So if you begin to lose your national credit or even regional credit and backfill to a local orientation, that property quickly drops from an A to a B, maybe a C property. And structurally, the net income won't rise again to a B or A type building unless you change the profile. But once you go down the slide, it's difficult to climb back up that slide. You can't take a property that has a local orientation and quickly spruce it up to a national credit oriented property again. So the stress or the decline in the rent, the stress that comes from a decline in rent can take many forms and come from many aspects of operating a property. And that's both a underwriting problem as well as an asset management problem. And so that's what we're seeing, at least. But I have a question for you, Adam. How is the volume of your deal, your overall deal structure? I know you handle many asset classes, all the asset classes, industrial, office, retail, and multifamily, but in particular to retail. How is the volume of opportunity in that space, retail space, been affected over these last 6-7 months?
I think it's been an interesting year for sure. And it's not like lenders don't talk to each other. So I think this is consistent across the market. I feel like Wisconsin has a general concentration of retail real estate that exists between, let's say, 1 million and 10 million in value. That's where a majority of our real estate exists in Wisconsin. And I would say in general, 75% of our loans end up being between 1 million and 7.5 million. That would be our norm. And there would be a decent mix of construction projects from a single tenant reposition all the way up to, a large scale big box with some outlot development type projects. They would be in the $20 to $30 million range. This year, I would say almost everything has either been 2 million or less, or 7.5 all the way up to 40 million. It's been the stuff in the middle is missing this year. And that's the same on the construction side as well. We've done some smaller deals. We're about to start a couple of larger ones. The 2 to 3 tenant strip malls, I just really have not seen much of those occurring this year. They may be, and it's just not in our, it's not going through Landmark, which would be unfortunate, but that's, I'm not hearing about that. What I am familiar with is there's 3 larger mixed use developments that we're in the loop on, and all of those, the land acquisition occurred this year finally, but they don't expect any construction until next year. And part of it's it's tenants saying, hey, we're interested, here's our LOI, hold on to this. We don't expect any changes in the terms, but we're not ready for you to start that construction project yet. We'd want it to start in 2021. To the owner saying, hey, I don't think I can maximize my value in today's environment, so I'm going to hold off. Even to the point of holding very low leverage on that land and putting a lot more equity into the project up front to make sure that they can hold it for a longer period of time.
Can I ask I could ask you to break for a second on that point?
Sure.
We're involved in the valuation of apartments, industrial, office, and retail. What we found is, with regard to multifamily, which most members of this audience, I'm sure, are familiar with, market rate multifamily, the revenue stream has remained relatively flat for that product, relatively flat. I mean, there are exceptions, but the costs have increased. And consequently, the profitability to a new development used to get squeezed because of that, that imbalance. So more often than not, what we're seeing today, and likely for the future, is a developer going back to the community and asking for some form of either subordinate debt or financing mechanism, TIF or other type public-private relationship, that allows the developer to cover the gap based on that increase in costs. If a developer desires to deliver a retail property, and due to a number of factors, including a reticence by the retailer to move forward with the deal today, in order to continue maintaining the being able to carry that asset without a revenue stream coming back to them, are you finding more and more the case that developers are seeking assistance from the public in the form of TIF or other measures in order to deal with the more protracted development cycle?
If we were talking about this last year, I would have said there's particular developers that are skilled at making sure they ask for municipal assistance, whether, some kind of TIF or other format. I think most of the developers are saying that this is an opportunity to go back to municipality. At the same time, I'd say a lot of municipalities are saying we're worried about our income stream for the next 12 to 18 months for sure. So I don't know how willing they're going to be to provide those opportunities. I hope they are, because obviously any new development is going to add to that tax base. You made a comment about apartment cash flow. Definitely on the high end side, we're seeing that plateau of cash flow. I'm still seeing, especially in a mixed use development, the opportunity to add incremental cash flow, either outright revenue from the sale of that parcel to a focused multifamily developer, or through basically allotting the entire development cost of the land to that parcel and still coming out on the positive side with cash flow. I don't know how long that'll last. I don't know if COVID will end up decreasing the rental rates on multifamily, but I have not seen where that's still not a good driver for a successful development, is to have that mixed use component. I'm really interested to basically see how the municipal concerns about their own cash flow compares to their desire to get more development going and increase the tax base.
Well, you just alluded to something that I think is going to become more commonplace, and that is a property veering toward mixed use that was not intended to become a mixed use. What I mean by that is, let's take Brookfield Square as an example. That's a very good example, and it's gone through some transformation over the last several years with the addition of the entertainment feature on the south end of the main mall. I think it's going to continue to realize a transformative environment. You'll already see that at the periphery with the transformation of, or the repurposing rather, of the Toys R Us site into a multifamily development. And honestly, with the, CBL is the owner of Brookfield Square, and they're in bankruptcy. And if you look at what Brookfield and Simon have agreed to do with Pennies, which is to take these boxes and find a way to repurpose them. If I had my hands on the Ouija board, I would say that the Pennies smack dab in the middle of the mall is a perfect last mile sub-fulfillment center. It'll be 1/5 the size of what Amazon is doing at the former JCPenney warehouse on 116th and Burleigh. JCPenney is going to, Amazon's coming into 540,000 feet, and you're going to have 1,700 trucks doing last delivery from that location 24/7, 365 days a year. The same could happen in a space like the JCPenney site at Brookfield Square. So I think by default, back to the municipality, they've laid a lot of money out to bring the convention center in, the new hotel in at the end of the mall, and they want a reward for that in the form of revenue. CBL is more than happy to pop up outlots, the 3 that have popped up along Moreland, plus the entertainment on the south end. But if CBL came and said, we need a little money to transform the JCPenney site into a fulfillment center, that site fulfills, if you will, all of the attributes a fulfillment center requires, and it's simply a microcosm of what Amazon is realizing at 116th and Burleigh. I mean, I really see that type of mixed use coming into a mall like Brookfield Square.
Do you think JCPenney's continues to operate in a traditional retail form, or is that space going to slowly just? transformed into something different.
You have really smart money, very well capitalized owners of JCPenney. You know, Berkshire Hathaway used to make underwear and shirts, and Warren Buffett doesn't make shirts or underwear anymore. JCPenney is just going to be a name, and it's going to be its future is going to be its rather is going to be a remnant of its future. It's not going to be a retailer. It can't compete. Sears swallowed up Kmart. Field and Simon will swallow up Pennies, and what they really bought is a distribution center. It's much like, you know, in your world, you guys are lenders. It's like a large bank coming in, Harris, or BMO Harris buying M&I. What they bought really was a distribution center for retail banking, and what Brookfield and Simon are buying is the distribution of the distribution channels that JCPenney has. It's not unlike, you know, Amazon buying Whole Foods. They bought into the mindset of well-padded consumer wallets. You know, the trend is very common in the marketplace.
I'll just throw out one thing related to that. I do believe that it's going to be an attractive opportunity for especially the larger malls, maybe even some of the mid-box space, to try and create those fulfillment centers, those last mile fulfillment centers. But I think it was Garrick yesterday made a really good point that how happy would you be if you're another tenant in that building and you've got maybe it's not pure fulfillment. Maybe it's an Amazon storefront with a fulfillment center behind it, or even, you know, just knowing that your landlord just gave Amazon an even better ability to compete against you. What kind of impact does that have on another tenant that's in the building?
Well, on one hand, it's a rising tide theory that may apply. That is, if one is prospering, perhaps all under that same roof would prosper. But it may also lead to a relocation of certain tenants. Some tenants simply don't want to be neighbors to a space user like a fulfillment center, whereas others may. Brookfield Square's food court is before pre-COVID, it was dead. I think if it had 10 outlets within that food court area, 4 were vacant. And so you have a bunch of people that need to eat on a regular basis from 8 in the morning until 6 at night, when most of the food court providers are in place. I think a higher head count would serve them well. But if the fulfillment center comes in, perhaps a jeweler right next to it that sells expensive rings and necklaces may not fare so well. So yeah, space user.
Tom, I want to pass a question on to you. How are you viewing new lending opportunities differently today, and what advice could you give to borrowers?
Sure. Yeah, I guess for borrowers, I would suggest, is the key. I would talk to your lender about what their approval process is like here in 2020. I think everybody's approval process has changed a little bit since before the pandemic. So try to get an understanding of how the loan's going to be approved, what parties need to be involved, and be comfortable with it. If it's a larger deal, maybe you have it not in a good way. Can the loan be pre-screened? Maybe not all the underwriting's done, formally approved, but can an opportunity memo be passed to the right board or the right senior underwriter? I've had other lenders call it a pre-flight memo, just to get a feeling if it's a doable deal or not. No one wants to see 4 weeks down the road, maybe the appraisal's been ordered with Pete, and then we find out that it's just not a deal we're interested in. So, there's something similar to that we've instituted here at Landmark to get some quick feedback to people and have some surety that the terms we're proposing are deliverable and it's a deal that we're interested in. I think that's key. Also, I would suggest being upfront with your lender. Explain to them what's going. If it's an existing property, share as much detail as you can that you know about what's going on with your tenants, what their experience has been this year, if they were forced to be closed or not, any sales info that you can get, and what the lease terms are. Pete touched on co-tenancy. I think that could turn into a really big story in 2021. If you've got a center where one anchor tenant or primary tenant is where we're all supposed to see, could send a clause off on other tenants, and you kind of get that negative waterfall. So be aware of that. Termination rates too in leases, and we've seen that sometimes. We're looking at a deal that's a 10-year lease, and we're going down the road, get a copy of the lease, and we read our leases. Our underwriters read our leases. I know Pete does too. And all of a sudden you find out there's a termination right after 5 years. Well, that's important. And now in this new normal, as we might call it, that termination might get called, where in years past maybe we weren't worried about it. If you got an underperforming store, tenants might exercise those and be out after 5 years. So that can definitely affect the loan amount and the amortization that you can have on a deal. And then maybe most importantly, I would say try to obtain as much information as you can from your tenants. And certainly we understand sometimes if you're looking at a new project, the leases are in place and tenants aren't required to provide anything, you might be stuck there. But if there's any financials you can obtain, store sales, something to provide your lender, to give them some insight on what's going on with your rent roll, what those tenants are experiencing, how strong they're bouncing back, hopefully is the case, would be key. And we've been working with earlier this spring, there was a lot of discussion around doing deferrals or limited rent, especially for tenants that were forced to close. And a lot of investors were willing to work with people to keep them there, keep them in business, and have them operating of the shutdown. A lot of the smarter ones negotiated, not only extensions of leases, but also the requirement to provide store sales or financials. So if you're getting into a negotiation where you're discussing some kind of a deferral or work that into the agreement so that you can see any trouble coming down the road. Pete, deals, you're seeing some trends probably in cap rates between credit tenants and maybe some non-credit tenants, more smaller business, mom and pop types, where you might not have a window into their.
Yeah, I'd say that in terms of cap rate analysis, the starting point was pre-COVID ideas of what reasonable cap rates would be, or a range of reasonable cap rates. And then, of course, people sensitize those expectations based on what they know to be the case with regard to the tenancy in place or the outlook for that tenancy or the real estate itself. So in other words, we're finding that there's the notion that cap rates should rise or increase, leading to assuming it's an income producing asset, that cap rate should increase, which leads to a lower value. But that's not, at first, that was applied by many valuers on real estate, but it doesn't do justice to those tenants that have withstood some of the external pressures of maintaining their business during these last 6 months. So when you look at a tenant that has figured it out, hasn't lost headcount, hasn't lost market position in their competitive space, continues to maintain their credit worthiness as a tenant, there's no reason to devalue that space occupied by that tenant per se, especially in light of a significant decision for fiscal policy on the part of the Federal Reserve to maintain low rates for the next 2-3 years. That outlook is
there. I mean, if you're looking at that component of the cap rate, that your 10-year treasury, it's so low. If you've got a really strong tenant, I would expect those to stay consistently low, at least for the next.
I would agree. I would agree. But those tenants, rather that space occupied by tenants that have seen a significant change to their business outlook, those are the, if you apply a cap rate under that scenario, those are the cap rates that are at risk of moving up. But clearly, if you've got a credit tenant under a long-term lease obligation, given the aspects of the marketplace we just discussed, there's no reason to make a significant adjustment to that cap rate.
Yeah, I would agree with that. I've seen on the other side of that, let's say you have a good tenant, but they've got 5 years left on the lease, and the rest of the tenants are kind of, they're decent, but they're not special, and you've got a more traditional turnover risk. We saw a couple deals that the cap rates are north of 8, one north of 9, especially if it's ultra reliant on that anchor tenant, and they're at 70-80% of the space. So you look at a financial today or a Starbucks, it's still going to be sub 6, and now we're starting to see some 8s and 9s on the other end. You mentioned a K-shaped recovery.
Right.
I'll give you credit for that, Pete. Could you expound on that just a little bit more?
Yeah, when our starting point is when we know the physical layout of K, the letter K, and there's a starting point in time, whether it's an effective date of today or at some point in the near future. The trajectory, the two lines from that starting point moving forward or going out in time, take divergent paths, and there are going to be some retailers, tenants, space, developers, and this applies not only to space, but it also applies to sponsors. It applies to marketplaces. There are going to be those that prosper, that fall into the camp of the upward trajectory, and then there are those that will continue to slide down because they're over levered, slide down because they've lost tenants and he can't recover because they don't have the capital necessary to reinvest in their property, and thus continue to position that asset to make it appealing to new tenants, or they've not attended to the deferred maintenance. So the divergent path of those that hang on and become the haves from those that can't hang on and become the have-nots is not unlike what we're seeing with many other asset classes and society as a whole, but in particular to retail. Look, in this country, we have almost 36 square feet of retail space per capita. Now, if you do the math against 340 million people, that's an awful lot of space dedicated to retail product. Our next closest competition is Canada, which has 8.5, and Europe, the EU in whole, has 6.5 square feet per capita. The EU is 340 million people, the same size as the US. Yet they have 6.5 square feet per capita, and we have almost 5 times that amount in this country. That's why consumerism drives 70% of the GNP. So there is going to be a fallout. There's, in the K outlook, there are going to be a lot of retailers that hit that downward trajectory and they won't survive.
That's why I asked you to join me, Pete. You're like the professor. I appreciate it. One last question. I know that a lot of people in the market are asking this question of us. And do you guys predict that we will see either significant distressed purchase opportunities or lender-owned properties within the next 12 to 24 months? And I'll start that off with Tom.
And not a wave. I don't expect a wave. I think there will be some, though certainly I don't think we can completely avoid it. Many landlords, many banks, credit unions have been very accommodating. This spring and summer, there's been deferrals, there's been reductions in rents, there's been maybe interest-only periods. I think that Not to mention all the government assistance that's come our way in different forms. I think that's going to start to wane in 20. And as Pete mentioned, that K recovery, I think somebody had coined the phrase, or I had first heard the phrase, the great pause, in one of the earlier sessions. And I thought that was a really good way to describe where we're at here, late summer and early fall. There's going to be winners and losers. I think we could all make guesses, but I don't think we're going to know who they are until the end of this year or early next. So I think looking at your own portfolio, trying to get out ahead of it, identifying where the weak spots might be, where the opportunities might be. There'll be a little, but I don't think there's going to be a huge wave. I hope I'm right.
I would say, that people like to look at the smart money. Most of us have a dollar or two invested in the stock market. The stock market is a leading indicator of economic activity in the country. It tends to lead the economy by about 6 months. So as it relates to real estate, where's the smart money today? Well, there's a lot of blind pools. In fact, year to date, almost $100 billion has been lined up in blind funds to chase real estate opportunities in the near future. Our own Congressman, Paul Ryan, and former Speaker of the House, joined the board of one such blind fund. These are pools of dollars that are set up or designed to facilitate deal making, and there's not a defined deal in place. They simply are telling a story, much like a .com in '99, telling a story about what they plan to do. These are blind pools of dollars that will acquire retail, as well as other asset classes of real estate. They're not going to buy at full retail, though. Their objective is to probably match the mindset of a vulture fund, meaning a 5-year outlet, maybe a 3 to 5 year outlook. But their intent is to buy at deeply distressed pricing. And what's interesting is, they're not dividing their mindset into tranches. There's not an equity and a debt tranche or levels of tranches with the debt. They're doing outright acquisitions of the whole real estate. And what you might find is by buying the whole you might find blind funds buying a whole mall. And again, back to the Brookfield Square example, repurposing the entire mall into multiple pieces. So it's not unlike buying a piece of vacant land and allocating some to commercial and some to residential and some to recreational and some to institutional. You might find the blind pools buying whole properties or whole companies and dividing the whole company up. But these blind pools are the rage. They're a leading indicator of where the market will likely be. And given the sheer volume of money that's been raised thus far in 2020, with the intent of buying property that categorically is distressed, I think there is a clear indication that in the foreseeable future, meaning in the next year to 2 years, we're going to see a significant amount of property being repurposed, acquired for purposes other than to maintain the retail format that we currently have in place in the U.S.
All right, well, guys, I want to thank you very much. Tracy said we have until 1:52, so I'll just wrap this up in the next 2 minutes and 12 seconds. I really want to thank you guys. It is a very interesting time for lenders. I'm sure it is for appraisers, and I know it is for investors. Just giving an example, we did a complete overhaul or a complete review of all of our commercial real estate when we were about 4 months into COVID. And, I mentioned in our sponsor message, we've put on $500 million of real estate just in the last 8 years. We put in one loan into our watch list out of that whole thing. We have seen most of the landlords be able to get through this period. The question that every lender has, the question that every investor probably has to some extent is, how long does this last? And do behaviors truly change because of what's happened over the last 6 months? Does it lead to a future behavior pattern that's just completely different? I think there are some things like grocery, for example. The right grocery stores the right discounters are going to continue to be strong tenants, great anchors, are really strong. But understanding who that tenant is and understanding the financial strength of that tenant is going to be really key, at least over the short term. If you've got a refinance coming, if you've got an acquisition coming, make sure you're doing everything you can to give the lender, maybe even an appraiser, a view of the financial strength of your primary tenants. That's really going to help. And with that, thank you guys for joining me today.